Hi, and welcome to another episode of Life and Equity, where I talk about life and life experience and equity, all things financial. Today, I want to talk about the different types of life insurance. Now, this is not an exhaustive list, but these are the most common life insurance policies, types of life insurance policies. I'm going to get into some attributes of each one. Now, I am a licensed agent, have been for over a decade. I'm licensed to sell term, whole life, and universal life. I am not licensed to sell variable life uh, because that requires a securities license, and I'm not securities licensed. I don't really care to be. So let's dive into each one of these and talk about some attributes for each. The ones that I'm drawn to and recommend are term and whole life, uh, universal life. It can be structured properly, but it rarely is. It rarely is structured properly, and it's even more rare for it to be funded properly. So I personally do not. I personally do not recommend universal life unless you've got a good one established already, or unless whole life is not an option. And then variable life. I do not sell variable life, as I mentioned before. I also wouldn't recommend it, and I'll get into reasons why. So let's dive in here. We're going to start with term insurance. Term insurance is specifically good for a specified time frame. That's why they call it term. So generally, term is either if it's a standalone term policy, meaning you go to your agent or an agent and say, hey, I want to buy a term policy, they're going to typically sell you a 10-year, 20-year, 30-year, or some variation. It might be 15, it might be 25-year. But anyway, there's a time frame in here. Now, something that I see a lot of people, when I ask them, hey, what kind of term policy you have? They say, oh, I've got a term until 80 years old. What's happening is they're taking these term policies and they're saying, hey, we will extend this out to 80 years old. So what the client hears is, I have a term policy that covers me till I'm 80 years old. What you actually have is a term policy with a level premium for 10 years or 20 years or 30 years or whatever the time frame is. And then it goes to an increasing term to 80 years old. So what that looks like is each year the cost increases over time. So you got a like I say, a level premium. So I'll just keep this simple. We'll say you got a level premium for a specified time frame, and then at the end of that time frame, the premium usually is a substantial increase. So it might start right here, and it goes like this. So as far as cost goes, again, you are level for a time, and then there's a substantial increase and it climbs from there. Yes, the policy will stay active, but what happens is it goes from a level term to an increasing term, or an annual renewable term is what it's called. So it's basically saying, hey, each year you can pay the new premium and you keep that policy in force for another year. Now, generally speaking, when there's this substantial increase, people cancel their policies because I mean, the price might quadruple or 10x from what that level premium was. I mean, it's a substantial increase, and they're like, whoa, whoa, whoa. No, I'm not signing up for that. And so it generally cancels. But again, what they hear when they buy it is, oh, I've got a term policy that's good until 80 years old. Yes, but the premium is outrageous. And if you continue to pay those premiums for the lifetime of that policy, you're going to pay way more than the death benefit was ever worth. So make sure you understand what type of policy you have. Okay. There is also a variation of term that's called decreasing term. And I just thought of another one here as well, and it's group term. So a decreasing term is generally sold by banks or mortgage companies. And what that does is it say, hey, we've got a 30-year note on a mortgage, let's say. And so what they say is, hey, we'll sell you a policy that covers the mortgage. So if you die, your mortgage is paid off. That's a decreasing term because your 30-year mortgage is going to decrease the entire time. Now your payment might be level, but the death benefit drops according to your mortgage, let's say, I've seen it offered on auto loans. They say, hey, we'll sell you a decreasing term. They don't call it a decreasing term. We'll sell you a life insurance policy that will cover the debt should something happen to you in this time frame. That's a decreasing term policy. Generally speaking, if you compare the price of a 30-year decreasing policy versus a 30-year level policy, you're going to be less expensive to do the level premium, and your death benefit stays level rather than death benefit dropping the entire time. So it's generally a better value, but both of these are available term policies. Now, another type of term policy is group, and the reason I say group is a term policy is because generally speaking, when you sever with the company, when you quit or get fired from the company, you also lose that coverage. So your policy is good until the day you quit or until the day you sever service with the company, and then your term coverage, your coverage is gone at that point in time. I do recommend. I sell a lot of, and I own a lot of level term. It's a great product. It's very straightforward. Just understand the time frame that you have it. Understand when it's going to take that massive spike in premium, so that you can prepare for it. And then also one attribute that a lot of these term policies have, especially these level term right here, they have a conversion option. Conversion. What that allows you to do is convert into a different variation of coverage, like a whole life insurance policy or possibly a universal life insurance policy. Depending on the company, depending on the type of policy, there's lots of different factors that go into it. But what that allows you to do is convert it for a specified time frame while that premium is level. Sometimes it's the entire time frame, sometimes it's a portion of the time frame. So as an example, I write with some companies that would say, hey, you got a 20-year policy, your conversion option is for that entire time frame. Another company I write with says, hey, you've got a 20-year policy, you have until 18 years into it to convert that policy. Now, the premium is going to jump when you convert it because you're going from a level term to a whole life or a universal life policy. So the premium jumps. So what it allows you to do is kind of like an ace in your back pocket that says, hey, if my health changes, I can always whip this policy out and convert it to permanent or whole life coverage. Uh, Whole life is also considered permanent coverage. Universal life is not considered permanent coverage, neither is variable life. And we'll get into the reasons why. So the conversion option is a great option. Not all term is created equal. Let me be very clear about that. Some term policies have much, much better conversion options than other policies. So just be very, very clear about that. Make sure you're working with somebody who you are very confident that they know what they're talking about. Uh, all right, let's jump into another variation, whole life. Whole life is Whole life is coverage where the time frame or the term, I mean, we were just talking about term, talking about a 10-year, 20-year, 30-year time frame for term, where whole life, the reason it's called whole life is because that time frame or that term is your whole life. So you've got guaranteed level premium coverage for your whole life. Now, obviously, if the insurance company is guaranteeing coverage your entire life, that means they know they're going to pay that death benefit out. So that being said, if you have 100% probability of paying that insurance claim out, the premium has to be substantially higher than, let's say, on a term policy where you're highly likely to outlive it. In fact, less than 2% of all term policies pay out. So it's a pretty good bet for the insurance company, which is why they can offer term insurance at a very, very low premium because they say, hey, statistically speaking, based on all that like millions of bits of data that they have, they say, hey, statistically speaking, this person is going to outlive that 10 or 20 or 30-year time frame. So yes, we're happy to offer it to you. Now, at some point, you can no longer purchase a term policy. The insurance company will simply not sell it to you. They just don't offer it because they know that the probability of payout goes substantially higher than what they're comfortable with. And so they say, hey, you can no longer buy term. However, we're happy to sell you whole life, but here's the premium. So there's some differences. So let's talk about some of the attributes of whole life. Whole life has a guaranteed death benefit. Again, as long as you pay that premium, they're guaranteed, contractually guaranteed to pay out that death benefit when you die. And that premium stays level, it stays flat your entire life. Another attribute of whole life is that you build cash value. That cash value can be used at any time for any reason. And the way you use that, the best way to use that is to borrow against it in most circumstances. Now, there are other circumstances like in retirement, you can withdraw money from your cash value. Sometimes it makes sense to borrow, sometimes it makes sense to just withdraw that money. So again, your agent should be able to guide you on the best times to borrow versus the best times to just pull money or rip money out of that account. And it really comes down to circumstances. How long are you going to live? Do you intend to pay it back? Do you have the ability to pay it back? Um, what other resources might you have? Do you have other things coming in, inheritances or anything else that might make that policy whole? And again, your longevity. How long do you, like, if you're borrowing, how long do you think that loan is going to be out before you pass away? So all those factors go into whether or not you would borrow versus just pull money out. However, either way, you've got access to cash value inside your whole life insurance policy, and that's applicable across the board with all whole life policies. They all build cash value. You should have access to every single one of them. I've not come across the whole life insurance policy where you could not gain access to it. Dividends. Now, dividends are not guaranteed, and some some companies, especially the mutual insurance companies, generally always pay dividends. Some stock companies, because there's mutual insurance companies and there's stock insurance companies. Some of the stock insurance companies do not pay dividends. Um, I've not come across a mutual insurance company that doesn't pay dividends. So I generally stick with mutual insurance companies. The policies I own are all with mutual insurance companies. I want to participate in those dividend distributions if they're to be had. So whole life, you do receive dividends. Whole life, whole life is easy to understand. So a lot of people out there say that whole life is elusive and universal life is transparent. Okay. Fair. That's fair, but you got to be in it. You got to understand the legalese to understand the transparency of it. So there's a difference between transparent and easy to understand. Universal life policies are transparent. They are not easy to understand. Where whole life insurance policies are very easy to understand. You have a contractual agreement and you could look at that and it's guaranteed that if you put this amount of money in, here's your cash value, here's your death benefit. If you put that in consistently over time, here's your cash value and what it's going to do on a contractual basis, and here's your death benefit and what it's going to do on a contractual basis. That is very, very simple. Premium in, cash value, death benefit. Very simple. So easy to understand. Whole life stands the test of time. Whole life, the type of whole life that we currently use today has been around for over 2 centuries, over 200 years. Now, the concept of life insurance policies go back hundreds of years. but the type of policy and the structure of policies that we use today are very similar. They haven't changed a whole lot in over 2 centuries. And the reason they haven't is because they don't need to. If you have a proven system, I mean, the will hasn't changed much over the last 2 centuries either. Why not? Because it works. And if it works, you don't have to reinvent it. Now, I mean, there are some variations of it. There are some additions to it, just like the wheels and that we used 200 years ago are very different than the wheels and tires and all the fanciness that we use today. So the some of the riders, some of the and the riders like additions and additional things that you can do it. Like those things have obviously changed over the last couple of centuries, but the concept and the basic structure and the principles that those policies are based on really hasn't changed in over 2 centuries. So they stand the test of time. And again, the reason they haven't changed is because it's predictable. And that goes to the next point. It's predictable, it's reliable, it works as expected, both for the insurance company and for the insured. It works as expected and it works every time. So why change it? All right. Whole life is a foundational part of traditional financial plans. Now, when I say traditional financial plans, I'm not talking about the typical ones that you see today. I'm talking about traditional, meaning going back to our parents, and in this day and age, I would say parents, grandparents, great grandparents. Whole life was just a part of the financial plan. It was, I mean, even what's that show? The oh, Christmas movie. Anyway, it's an old black and white. The name escapes me right now. But he talks about it in there. It goes. It's a guy's lost everything. He started a bank. He lost everything. Goes into a different banker and he says, "Hey, I don't have any. I don't have anything of value. Like, and this is an old black and white movie. He says, I don't have anything of value. The only thing I have is my life insurance policy. Well, whole life insurance policy is considered an asset. It stands the test of time. Again, it's been a thing. It's been in place for over 2 centuries, the kind we use today. So it used to be a financial part, a financial component, a foundational piece of a traditional financial plan for generations. It's only recently been replaced. I will say replaced by 401ks, IRAs, and the more typical planning that we see today, certainly not traditional. So this is a part of a traditional plan, and it's very, very beneficial, even with typical planning, to incorporate life insurance, specifically whole life insurance. Universal life. Universal life, and that includes guaranteed universal life and indexed universal life, or GUL and IUL. Universal life is a spin-off of whole life. Universal lives have, relatively speaking, I mean, they've been around for decades, but relatively speaking, they're kind of like the new kid on the block. It's a spin-off. In my opinion, they have not stood the test of time. They have not. I mean, what the insurance companies did is they wanted to try to compete with 401ks and IRAs. And so what they said is, hey, we're going to introduce a product that allows the client, supposedly, allegedly, I'm going to use allegedly allows the client to participate in market gains without bearing any risk. So right off the cuff, right off the cuff, common sense says, hey, if I'm participating in market gains, what am I giving up? Because there are no deals in insurance. There are no deals in insurance. And if that's a fact, and it is, then you can't have market gains and zero risk at the same time. Something is wrong. Like there's something off with that. So let's get into some of this stuff. Now, universal life, it has the potential of gains. And you'll see that in their illustrations. They illustrate phenomenally. But an illustration is just a projection, and a projection I can pull out of my back pocket. It doesn't, there's no fact to it. There's no validity to it. So be cautious with what the projection shows. There's highly likely that it will not perform as projected, which is a problem. But there is a potential for gains. There is a death benefit with universal life policies. The death benefit the death benefit will pay out as long as you die, as long while that policy is active. So that's good. Now, and I say there's a death benefit until there's not. So there's a death benefit until it goes away. The problem with universal life policies, and I'm not, this is not an exhaustive conversation here about the issues with universal life policies. But one of the problems is they go and they go and they go and they go, and then suddenly they stop. And there's very little, if any, warning. There is warning, but if you don't know what you're looking for, if you don't know it's a warning sign, and it doesn't come as a red blaring sign, it just comes as a statement and you don't even realize it because it doesn't say anything about a warning on there. But it's happening if you know what to look for. So it'll go and go and go, and then suddenly the policy stops. And we'll get into some why there in a minute. In fact, it's listed right here. The problem with it, universal life policies are built on a 1-year renewable term chassis. So what that means, going back to the first illustration I said about term, I said it's an increasing term. The cost increases every year. And by the time you reach 80 years old, you will have paid a lot more into that policy than it was ever worth. Well, if you have what you think is a whole life policy built on a 1-year renewable term chassis, what's happening is the cost of insurance is increasing each year. And so what happens there is you can build cash value in the beginning. Just like a whole life policy, there is cash value in these policies. However, the costs associated with the life insurance policy or the costs associated with the plan increase every single year. And when you get to be older, they start increasing substantially. And what happens is the cash value gets eaten up. And so you've got coverage until that cash value gets all eaten up from insurance costs. And as soon as your cash value is gone, your coverage is gone. And then the insurance company says, thank you, have a nice day. Bye now. You thought you had a permanent policy. You didn't. You had a universal life policy. You thought you had a whole life policy. It's not whole life. So make no mistake. If you have a universal life policy, make sure you talk to somebody who knows what they're talking about. Now, I'm going to get a lot of flack for this because there are a lot of universal life agents out there. Now, let me just disclose here. Most agents are very, very well intentioned. They believe that the projection is going to be what the policy does. So they're well intentioned. They're not doing any harm on purpose. In fact, they believe they're doing the best thing for you that they can. I will tell you, though, that those policies, I've seen way too many of them rip themselves apart because they never perform as projected. And when they don't perform as projected, the costs eat them alive until you get that notice that you now no longer have coverage. All right, universal life policies are very easy to sell. So with whole life policies, I said they're easy to understand. Universal life policies are easy to sell. Why do I say that? Well, because I can illustrate phenomenally. It doesn't mean it's going to be reality. It doesn't mean the policy is going to perform anything like it, but I can make the projection look magical. And you'll want to buy it because you'll believe that you have market returns with no risk. That's how they're sold. That's not the reality of it. Again, there are no deals in insurance. All right, universal life policies lack guarantees. You will not get a guarantee that that policy will last you your lifetime. It is not considered permanent coverage. It's considered a universal life policy, not a permanent policy. And that's because there's a high probability that that thing is going to eat itself alive before you pass away. Again, I've seen it way too many times. So there is no guaranteed death benefit. There is no guarantee of cash value. That's not good. If you're using this as a foundational component, you want guarantees in your foundation. You don't want instability. You don't want a rocky, a sandy foundation. You want a solid foundation built on solid principles. All right, 1 year renewable term chassis. We already talked about that. The cost of insurance goes up every single year. So some of the benefits. It can be, but rarely is structured and funded properly. It can be. Most agents don't understand how to structure them properly. And when I say properly, I'm talking about so that they will last you your entire life. They can be structured that way. Actually, I can count, after doing this for over a decade, I can count on one hand all of the universal life policies that I've seen structured properly. Okay. And a couple of those were illustrations that I created. There has been a couple that have come across my desk where the people said, "Hey, this is my universal life policy." And I said, "Hey, you know what? Keep that. Don't change that because of this or this or this reason." So it can be, but is rarely ever structured and funded properly. Even if it's structured properly, if you don't fund it properly, again, that thing is a high probability of running out, and that's not good. You want that life insurance policy to last you until you die. You don't want it to cancel ahead of time. Last but not least, it is protected against market risk. That's true with universal life policies. So what that says is, if the market goes down, your balance does not go down due to market risk. That's true. However, it's not it's not protected against cost risk. So even if your cash value does not go down because of market risk, it can go down because of cost risk or that increasing cost of insurance. So yes, cash value from universal life policies do vanish. When I say vanish, I mean it gets eaten up by cost of coverage. That is a uh, very real scenario and a dangerous thing to, if you think you've got something and you've really got something else, if you think it's going to do one thing and it really does something else, that's not ideal. So universal life policies, if you understand it, if you understand the risks, if you're willing to take on those risks, it might be a good fit. If it's structured properly and funded properly, that's even better. I would say probably 99 out of 100 times, you would be better to go with a whole life policy. And you can structure the whole life policies similar, similar. Let me put it this way. You can structure a whole life policy to accumulate cash value actually way better than universal life policies ever considered growing in general. And you've got all the guarantees. So it's vital that you're working with somebody who knows what they're doing. Excuse me, who knows what they're doing. All right. Then there's variable universal life policies or variable life policies. Again, I'm not licensed to sell variable policies. What I will say about this is they are life insurance policies, and there's an investment component to it. And that investment component, you are directly invested in the stock market. You have the potential for gains. You also have the potential for loss. Um, I personally can't see any reason that you would want to own. I can't think of a good scenario where I would want to own variable life insurance policies, and I choose not to sell them. Anyway, hope this is beneficial. Variable policies are generally on a universal life chassis. So you've got the increasing cost of insurance along with the potential of market volatility. It can be a recipe for disaster. You got a recipe for disaster and a recipe for disaster. You throw those together, they don't cancel each other out. They multiply. So if you're going to do that, you might as well go buy term insurance and invest the difference. you're keeping those things separate. And again, to me, it just makes way more sense. Anyway, hope this was helpful. Again, this is certainly not an exhaustive list on all this stuff, and there are additional variations of all these that are used in certain or specific circumstances. But these are the most common types of life insurance policies: term, whole or permanent coverage, and a universal life chassis, some variation of universal life. Anyway, hope this was helpful. If you found this useful, please like and subscribe. And of course, if you want to see, please comment and let me know if you'd like to see more of something, go into detail on something, or a different topic altogether. I'm happy to consider that. So till next time, stay well.